Today we're going to talk about director loan accounts and dividends.
Did you know that taking money the wrong way from your business could cost you thousands?
Ooh.
I know, interesting.
Very interesting.
Do you see that, Emma? Is that something you see?
I see that a lot, actually. I have a number of clients that, do go either way of the spectrum, essentially. Yeah. You have the people that pay themselves a pittance and nothing. Yeah. And then you have the people that are potentially living a lifestyle that their business actually can't support.
Yeah, particularly when there's been a decline or something in the business.
And sometimes you see it where you've had, especially in businesses that are quite that have a longevity about them, where maybe they have had a heyday and they haven't quite recognised that the business is in maybe decline and they haven't quite pivoted into a new world, a new market, a new industry. But their take-ins are still equivalent to how they were. Yeah. And there doesn't seem to be a recognition or an appreciation that actually they're damaging their company more so than they could be.
Yeah, exactly. And I think especially where you've got a company where it doesn't have the reserves that have built up, perhaps they've been taking those out each year. So you've really got a company each year, it's sort of starting again with whatever profit it makes. And then you've got a shareholder who's, like you say, been taking a lot of money out of the business for a long time, continuing to do that. And suddenly we get to the end of the year and perhaps the cash isn't actually in the business to pay the corporation tax. Yeah. Well, that's quite a big clue. If you haven't got enough money in your bank to pay the corporation tax, you've taken too much money out of your business. Yeah. So that's sort of, I always think that's quite a good way of kind of looking at it on those companies where they're running like that. And if that's the case, then what we end up with is an overdrawn director's loan account. And this is where it can cost you thousands. Because essentially, if you've got an overdrawn director's loan account, then you end up, and it can't be repaid within 9 months of the year end, then you end up paying Section 455 tax, which is paid by the company, and it's at 33.75%. So it's sort of top end of the dividend tax, if you like. That's where the rate comes from.
And if you don't have the cash already, in your business or personally, that is going to hurt.
It is. And that's the point. If you've taken out too much, at some point, you're going to have to pay some sort of tax. So you're going to have to put some money back in. Yeah. So I think that's where it's really, really important these days to use what's available. So particularly the accountancy software, so the likes of Xero, QuickBooks, Free Agent, any of them really, they all allow you to report on your profit and loss and see what you're making. See and run a balance sheet and see exactly what reserves you've got in there, where you are with it all, and make sure you're not getting into a situation where you are taking out too much money and ending up with an overdrawn director's loan account that is going to potentially cost you in tax down the road. So it's using what's there, and I think that's where people, perhaps if they don't have the finance team or don't really know how to use the software maybe, or don't have the relationship where they feel they can ask your accountant to help you, because it's very simple to run the reports and look, but it's just knowing how to do it. And if people don't know what they're looking for, I suppose there's no point running the reports anyway.
Yeah, and I think running on from that, there's also the aspect is, I think sometimes you do have owner managers that actually do know all of that.
Well, there is
but
that.
Still carry on.
There is that. There
and
definitely is that.
Actually, I think sometimes there is the technical side of accounting of, is this the right thing to do? Is this the wrong thing to do? That's pretty straightforward. I think then what makes it muddy is obviously the emotional relationship with money. Yeah. And sometimes it's not just about taking money out of the business, it's what that money is then supporting and a lifestyle that has been created, and maybe a lifestyle that people don't feel they can row back from.
Yeah, definitely.
And I see that as quite a common occurrence.
Yeah. And I think also that people feel they're working really hard for a business, and if they were going to go and get a job working for someone else, well, they'd be on a salary of 100,000 a year. That's fine. So therefore, I'm entitled to take that money out, because I would be if I went and worked somewhere else. But unfortunately, as we know, when you've got your own business, you're not entitled to anything. No, you've got to make the money to be able to have the entitlement to take the drawings and the dividends out of the company. And I sometimes feel that a little bit, that I think people think they should be able to take it, regardless of whether it's actually there to take.
Yeah. And I think something that actually would be really great to get your take on, or your professional advice on, should I say, is that there is this common... I often get told by my clients that if I sit there and say, look, we haven't made a profit this year, your dividends are obviously going to have significant impacts to, the future, cash flow, etc. There's this kind of almost statement that, I don't know if there's an entrepreneur's book out there where it says how to turn around and speak to finance people when it comes to my personal money book. I'm sure there is. And they basically say, yeah, but I've got reserves in the balance sheet.
Yeah, okay, that's an interesting one. I suppose ultimately the reserves are there. If the cash is there, technically, you could whittle down your reserves. But by doing that, you're obviously devaluing those reserves. They're depleting, they're going. So if you were to go and sell that business, you don't have that value in your balance sheet, essentially, to sell. But also, I think if you're depleting your balance sheet, i.e. using those reserves each year, then it's not sustainable.
No.
And I think that's the point, isn't it? That when you're looking at how much you can pay yourself and that setting that sort of level of dividends, it should be sustainable. You because otherwise, okay, you might do that, 2 years, even 3 years, but 4th year, you can't. You've now no value in your company. Everything has been used, if you like, it's gone. And then what? What do you do at that point?
How do you tackle that when you see that? Because I suppose you have the privileged situation where sometimes you only see people's books annually.
Yeah.
And then actually by the work in year 2, you will be able to say, I think there's a trend happening here.
Yeah.
You're taking more dividends than you are profits that are being made. How are you? Because there's also, I find it really funny that there's sometimes a disconnect in the owner's mind from investing back into the business, and how their dividends and taking dividends has no impact on being able to have cash to reinvest back in the business.
Yeah,
and there is no correlation there, and I find that I find that sometimes quizzical of how they can disassociate their money or their perceived money from actually the business should still grow.
And I think that goes back to what I was saying, where people feel entitled to a level of money because of what they're doing. And therefore, once they've got that money, that was the bit they were entitled to. So, well, they've either spent it, so there is nothing to potentially put back in anyway. It's gone. And well, why should I put my money back in?
Yeah.
But I suppose a true entrepreneur knows that sometimes you have to put your money back in to actually enable the business to potentially just continue, or at least, it might be to grow, but it could just be propping it up for a period of time where, you've got a tough 6 months coming up. The horizon perhaps is looking good, but you've got that short-term problem. So you have got to put a bit of money back in. You might be able to take it back out down the road, and hopefully that's what you're going to do. Hopefully it's going to build and become more money that you can take. It's very difficult being a business owner, is that there is no certainty.
No.
You're not working for someone. You don't have a regular amount of money potentially coming in every month that is guaranteed. You are running your business, and you have to kind of go with
the ebbs and flows.
Exactly.
Yeah.
Every business has them. Very few just keep going up. Most will hit problems here and there. And I think I suppose it comes down to the responsibility in a way, isn't it, of being a business owner, is riding that out sometimes and take the good, but then you have to pull back when times are tough. And having that conversation, as you asked, is really difficult, because I think people don't feel they should pull back.
When you're trying to have that conversation,
how?
But I suppose, do you ever get the results that you want? Because I suppose from your perspective, you are looking out for the business's interests.
Exactly. I think it's a bit of a mix, to be honest. We had quite a lot of businesses after COVID that were struggling, and one in particular I can think of with a couple of guys, and they'd always taken out a set amount of money. We don't really have a huge amount to do with them during the year because they've got an in-house finance team. So come the year-end accounts the next year, which was probably 6-7 months, the meeting post-year-end, it was in a pretty bad situation. And it was a pretty difficult conversation to say, if you carry on like this, you don't have a business next year. So you have to scale down what you are taking out of your business to be here next year, because you are only making X amount of money, but you're taking twice that at the moment, and it's allowing you to do that. But as you say, only because they've built up reserves, and that's only going to continue for so long. And actually, with that one in particular, was extremely well received, because it was a bit of a wake-up call to them to go, okay, well, we want to take this money, so how do we get the business? Can we get the business back to them?
Exactly.
Meanwhile, we've got to scale back. We're going to have to reduce our drawings, which is the outcome you want, because that's responsible, isn't it, essentially?
Had they made the connection, though, that it was their dividend drawings that was actually causing that level of hardship?
No, I don't think so, actually.
No.
I think it was almost like, when I said that to them in the meeting, that was really the first moment in time I think they'd actually thought, oh, we can't take this money out. Just because we always had, we're not making that money anymore. So it was quite, and I did leave. I left and felt really bad.
Yeah.
Because it was like I was telling them something they didn't know.
Yes.
And
yes.
I'm an accountant, I'm a business owner, but I know how my business is doing, and I know how to know how my business is doing. And sometimes I forget that people don't always understand these things, and actually just maybe don't know. And therefore it is a shock when someone turns around and tells them a reality that they perhaps just hadn't realised was a reality. And I think that was really genuine with the one I'm thinking, or the clients I'm thinking of. And interestingly, so this was a couple of years ago, the meeting the following year was tough. Things hadn't improved, I think. But then, having said that, we were quite far into that year already when I went to see them. So if you think about the changes they were making, most of that year hadn't had those changes in. So we weren't in a dissimilar situation at that point. But the following year, things had completely turned around.
Amazing.
The profit had increased. They had lowered their drawings, or their dividends they were taking by a huge amount. And suddenly we were looking at a completely different business again. Yeah. And actually, as an accountant, that was really, really rewarding.
Yes.
To know that, okay, if you hadn't, or if I hadn't have had that really difficult conversation with them,
they may not even exist.
I don't think they'd have been there, to be honest, at the point where we are now. So, yeah, but it's not always received like that.
No, I can imagine.
That's kind of a nice story, I think, of how it is. But sometimes there's just denial, I think, with it, because people don't want to accept that it's not going in the way that they think it's
going in the way it should, because I'm sure you see this and I see it, where you have owner managers taking out their dividends. They then get their personal tax bill, and then they turn around and go, well, I need to take dividends because I've now got a personal tax bill to pay. And then you go, okay, but you do realise you're now going to pay tax on your drawings to pay your tax. And they're like, right. And I was like, can you not see that we're now compounding the problem, and that whatever dividend, because you're still going to want to take the same amount of dividends, but now you're taking this extra lump in order to smooth the lump of personal tax.
Exactly that.
So each year you're going to get slightly lumpier. And at what point does this stop? And at what point do you not take your dividends and go, actually, I need to put a percentage of this away because this actually isn't mine, this is tax.
Yeah. We see that a huge amount.
I bet.
It's a really, really common thing that we see. Because, like you say, I suppose they haven't had the foresight to put the money away for the personal tax, get the tax bill. And I would say at the start of trading, obviously when you're paying your income tax, you're actually paying 2 years worth of income tax.
Yes.
So if you haven't had that proper planning from the start, then suddenly you get hit with this huge tax bill because you've thought, okay, well, I'm going to pay tax on my dividends at 8.75% if I've only taken the sort of the basic rate band of income. But oh gosh, now I've got 2 years because I'm paying on advance for the next year. So we do see that as well sometimes, and it's not normally clients that we've actually set up, but they've maybe traded a year into their second year, just done a personal tax return, and then been like, well, my accountant didn't tell me this. I didn't know I was going to have this tax. So I've had to take it out of the company to pay it. Yeah. And that's where it then starts this sort of snowballing effect of having to take your personal tax money out of the company, then having to declare more dividends the following year to cover that, then getting a bigger tax bill to cover that, then having to take that money out of the company. And it just keeps going on and on. And I think the answer sometimes with this is just poor planning from day one and not being advised how to properly actually keep some of that money back to pay your personal tax. It doesn't always happen that way. Sometimes it's just things have happened throughout the year. You could be 10 years into a company and you're in this situation for different reasons. But good planning can really help with that, I think.
And do you ever have owner managers come to you and actually say, what should I be taking?
Yes, we do.
Do you?
We do. No, we do. I was
so
just thinking
glad to hear that.
Do it? No, we do. And obviously they're probably the clients that you've got more contact with that are a little bit more switched on, I suppose, because they're the ones that are actually have the foresight to think ahead and to think there probably is a right and a wrong answer to this, rather than I can take whatever I think, whatever's in the bank. You know, that there is a right and a wrong answer to it. So we do get that, and then I think it's great because you can sit with them and you can actually plan out and give them an idea of what their personal tax will be if that's the level they're going to take. Have a look at the profit in the company, make sure that okay, it looks like we're at a level where that's going to be okay. You can pay the corporation tax, we can cover the dividends. So those are kind of the perfect clients, really, I would say.
Number of conscientious people that don't take any dividends during the year and then wait till they've got their stat accounts and then almost ask for permission of what they're allowed.
Yeah, we have some.
And I always think that is such a beautiful way of working. The fact that
how much money have I made?
Exactly. How much have I made? How much should I take? And what's the right balance between reinvesting back in the business and also looking after, you know, my own, you know, interests, because it can be highly rewarding owning your own business. It can also be quite the opposite, especially when things aren't going the way you want them to. So I always think it's quite interesting that watching lots of different people psychologically navigate the world of dividends and how money means so many different things to people.
Yeah, no, I think you're definitely right. And I think it's quite confusing in a way, isn't it? You know, you start your own company. The first thing I always say to my clients is, remember, you and your company are two different
separate
entities,
people.
Separate people. You are not your company and your company is not you. Yes. You're separate. It's not like perhaps if they were a sole trader who's incorporated, they've had that mindset, well, they are the business.
Yeah.
So I think, first of all, that's a really key thing to get across to people, because then people understand that they're paying money from the business to them, and they can also sort of start to understand about how it works in terms of, is there enough profit in the company to pay these dividends, because they are not the business. I just think understanding that really key bit of information really helps make sense of everything from there, if that makes sense.
Oh, absolutely. And it's really interesting, because obviously I always say this when I go into new clients, nobody sets up a business to have beautiful accounts. No one says, you know what, I've got this really big entrepreneurial idea that, you know what, my balance sheet is going to look beautiful.
True.
So I completely understand that, you know, sometimes finance is a bit of an afterthought. And I suppose the dividend and the taking of dividends is a kind of signifier of how successful they have been in their own ventures. Yeah. And I think there is a lot of emotion attached to it.
Yeah,
I think when you have to have those conversations to say, you know, if you carry on like this, you won't have a business. I think it goes back to, you know, a point we made earlier, is that, you know, some people do have that avoidance with the accountant because, you know, you might actually tell them the thing that they know and they don't want to quite do. Exactly. Yeah. It's like when you know you shouldn't eat so much chocolate and yet you somehow just manage to consume it.
Exactly. It's best not to ask.
Yeah, it's best not to ask and just be in, you know, quiet denial.
No, that's so true. I mean, so many clients, they avoid us because they don't want to be told perhaps exactly how things are within their business. So they just avoid us.
Do you think, though, when you're having those conversations, sometimes people realise how close to the edge of losing their businesses they can be?
No, probably not, to be honest. I don't think they always truly understand what it means to be in a situation where you have taken out too much money from your business and as I say, have this sort of overdrawn director's loan account. I don't think they really understand the implications of that. And obviously if that just keeps compiling, it's very difficult, isn't it? I mean, how do you sort of explain that to someone? I struggle even to explain that to people sometimes because it is quite a difficult thing to get your head around, and to know that basically you owe that money back to the business.
Yes.
If you can't cover it by dividend and you end up with an overdrawn director's loan account, essentially you owe it back to the business. That's the bit I think people can't get their head around, because they're like, but I've taken it. It was my money. I've taken it. But no, it's not.
It's not your money. It's
at the moment, it's just a loan to you. That is what it is.
And I think there is that distortion in in the way people see it. You know, I've built this business, I own this business, it's mine, so therefore the money in it is mine.
Yeah.
And it's really funny because when I talk about Bubbles money, it is Bubbles money. It's very much a set. And I mentally do that thing when we're having, you know, if we're having a personal finance conversation in our household, it's very much like, well, this is what we've got, but this is what's in Bubble at the moment.
Separate entities.
And from the very get-go, I've been very clear to separate the ownership of the money. Because I see it happen so often where people are like, oh, I'm one with the business and the business is one with me, and we're all the same thing,
doesn't it? I think very muddy water over where that money is. And you're right in terms of what you say. People think, well, it's fine because I've got loads of money in the company at the moment. Maybe forgetting that a VAT bill is going out next month. Corporation tax has to be paid out of that. So actually all that money that's sat in the company anyway, it's not yours.
Exactly, it might not be yours.
No.
And I actually think modern banking apps are making that really, really helpful, because I know that when I've set my bank account up, so that when I receive money, 20% of that automatically gets filtered off into a VAT account.
Great.
So I never ever see that. And the nerd in me can't help doing my month-end accounts. I'm very proud, and I'm always proud to be able to tell you this, actually.
I love that.
I kind of use a corporation tax app, and I work out what it is, and I put the provision in, and then I siphon that off as well. So I've got these pots which, although it's still money in my bank, they're not that's not my money.
I do exactly the same for Morris Palmer. I have my VAT account and my corporation tax account, and I say to my clients, I can't force you to do that, but I think it's a really good
highly advisable
a really good way to ensure that cash flow is there and you're not taking something out that doesn't belong to you. Because that's the thing, it doesn't actually belong to you.
No, and I think people forget that, you know, when you're paying your VAT bill, you are just collecting essentially on behalf of the government.
Exactly,
you know, there isn't any influence you can have on that. No. And a good question I ask, you know, my clients, if you can't put your VAT money away and you can't put your corporation tax money away, why not? What is happening? Because if you're making a profit and you've got positive reserves, where is everything being tied up in? Where's
too much out?
Exactly. There's jam in the system somewhere.
Yeah, exactly.
And so let's shine a spotlight on your balance sheet.
I suppose that's why it's so good to actually start from the beginning, how you mean to go on, isn't it?
Yes.
And have all those things in place from the beginning, so that you don't then 2 years, 3 years down the line have to kind of undo things.
Yeah.
And then it's so much harder, isn't it? So, you know, I think it's just so important to talk to someone right at the beginning and make sure that your business is set up in the right way. You've had that advice. You're not going to get into any sticky place, that you're taking too much money out of the company that you shouldn't have taken out. And just doing it the right way, I think, from the start.
I think that's absolutely right. And I think also this is where forecasting really helps, and knowing your market, and also planning out any investment for growth that you're going to do. So the conversation makes me laugh, because I know there's a number of clients that I've got that sit there and go, oh, I've got all this money in the bank, I can see it. And so I can do this expansion project, and I'm going to do this piece of investment. I'm going to continue taking the same level of dividends, because I haven't associated that the dividends I can draw is based on the reserves in my business. And also I haven't also calculated my working capital. So actually, whilst I'm doing all this really exciting investment over here, what do I actually need to trade?
Yeah, exactly.
And then what do I also need for me?
Yeah.
And it's really funny how sometimes people work in those very isolated bubbles, and that there's no cause and effect between them.
Yeah.
And they're like, well, of course we've got no money because we've invested it all doing this. And it's like, well, that's why you can't pay the day to day.
Yeah, exactly.
You're still taking the dividends, but I still need to eat. And I'm like,
I know.
I get this, but this is a cake and eat it situation, and you've got to put the spoon down.
Yeah. Put the spoon down. Like that.
But it's true, isn't it?
Yeah, no, it is, exactly. You can't have it all, can you?
No.
That's the thing.
And I think this is why people need to speak to their accountants more, especially if their in-house staff are not at a calibre that can help influence these types of conversations.
Yeah, and to be fair, most probably aren't in that situation, are they? When you think of sort of an in-house finance team, it's generally more of a bookkeeping nature, more of a data input nature, which is fine and serves a really good purpose. But sometimes almost too much responsibility gets put on those people who haven't got the experience to advise in on those sorts of matters. And I just sort of, it's almost a bit unfair in a way to put that pressure and responsibility on people, isn't it, who aren't qualified to give those answers. And then when it gets to the end of the year and you do the accounts and, it hasn't actually gone how we thought because, but they did what they were told with their in-house finance team. I do see that sometimes. And I just think if you want those decision-making processes in-house, then you have to make sure you've got the right person in-house.
And something I do quite a lot for my clients is help redevelop their finance teams. Yeah. So like I said, no one starts off because they want a beautiful finance team. Yeah. But I think what people overlook quite a lot of the time is finance is still a technical practice, whether that's in-house or whether that is in like official practice. And I think some entrepreneurs, owner-manage mistake of, I just need a bookkeeper. Yeah. That's all I need. I just need someone doing the books. And actually, I think as you grow, your requirements are actually a lot more need to be more considered
at the start.
Exactly.
But things change and things evolve, and it's particularly rapid growth.
Yes,
I think people can so easily get caught out with. They're just not ready for it. They haven't got the advice on hand, the skill set on hand for that growth. And then you have to kind of reassess as you go, don't you? And say, okay, well, that worked then. What do I need now? Do we need a finance director in-house? Maybe we're not quite there yet. Maybe we need a bit more support from our accountants to kind of bridge the gap, maybe.
Exactly.
And we do that quite a bit. You see that quite a lot where people aren't, they've got a bookkeeper, they're not quite ready for the next step, but they need something in the middle. And then that's where then we can help, just be a little bit more involved, whether it's just a quarterly check-in, those sorts of things, just to make sure that they're on the right track.
On the straight and narrow.
Yeah, exactly. And I think there's a lot of benefit in that. And I sort of see, when you look forward to accountants, the role of, where they'll go, it's that kind of more consultancy advice, maybe, as opposed to actually working out the numbers, because that bit's almost quite easy, really, these days, isn't it?
Yeah. Technology has definitely made it easier to be, to have good accounts.
Exactly. If you've got good data inputting, then with all of these softwares, you can run the reports you need to work out how you're doing. But you can't necessarily apply the advice to that, if that makes sense, to work out where do you go from there. So that's where I think then that contact with the accountant is really beneficial, to have that advice.
And I think something else that's interesting, when you're choosing your finance team, it's actually hard sometimes to pick out who is a strategic thinker, because I think that also gets overlooked. That I think, like you said, some people think, it's just data entry. As long as the data's in and the suppliers are being paid on time and our debtors are relatively well, I don't need to worry about that. Yeah. Whereas there is no future outlook sometimes. And actually, do you know what? I've noticed this or I've noticed that, because they've got a, like you say, a more data entry, a more process driven type of finance department. And it's actually, how curious are you about your business data and what is your business data telling you? So to get back to your point, if you're taking too many dividends, have you noticed that you may have decline in sales? Have you noticed that your cost of goods might have rapidly shot up and your gross profit isn't where you think it is?
Where's your bottom line? Is your bottom line where you think it is?
Exactly. Who's controlling your overhead costs? Have you taken on stuff that is maybe too much for the business right now? Where are you? Yeah. And quite a lot of the time, I know when I go into clients, they're almost like, that's why you're here. Unravel the mystery.
And I'll be honest, that's why I love Xero. Absolutely love it. I think it's brilliant software. But I love the reporting functionality.
Yes, so do I.
I love that you can compare months. I love that you compare departments, all those sorts of things. And you can really see the trends. You can really see how it's doing. Particularly if you do sort of month by month, what's the trend?
Yes.
Is it going up? Is it going down? Are your overheads going up? Are they staying fairly consistent? Which is probably good to then kind of monitor your gross profit and see where you are. Like you say, if your cost of sales suddenly gone up, is there something you're buying, costs gone up, but you haven't then reflected that in your your turnover and your selling price. It's just really, I think it's really good to see at the click of a button how your business is doing.
Absolutely. And this is just such a minor sidebar, and it's got actually nothing to do with dividends, but while we're on pet peeves of things we see, I am always so surprised. Lots of accounts departments at month end do not do a variance analysis of their overheads.
Yeah, agree.
And then you get these holes where people are like, oh, we haven't been releasing, I don't know, insurance for the last 3 months, and then before you know it, there's £8,000 coming off the bottom line. And those little small like checks and balances.
Yeah, you're right.
I was with a client recently that said that they don't do any hard closing because there's no point. And it was like, what do you mean there's no point? There's lots of point. There's lots of point here. We don't know what's going on. You. And there was this moment of actually then having to convince people why month ends and fully reconciled balance sheets at the end of each month end is really, really beneficial to the business. And if it's got a growth strategy, it's growth strategy. Yes, it's boring. Yes, it's technical. But if they ever need to be audited, at least then we're not doing what happened 17 months ago? Why did you do this journal? Like, I remember when I first started out,
question.
I remember being maybe in my mid-20s having an auditor sat next to me going, in this comment, you've just put correction. Do you remember what you were correcting? No, it was 17 months ago. I'm 25. I don't care.
So now you've got loads of detail in everything. So
now it's just like War and Peace in the remarks button. Going, I remember this vividly.
But it's so much better that way, isn't it?
But it is, because then you do see that. Yeah, but I think it comes back down to that dividends piece of checking in of like, am I taking too much? Should I be taking less? And I think that's where we've just got to. So hopefully this conversation will have had some, maybe set off a few bells.
We can but hope, can't we?
Exactly. We can but hope. So if you're watching this and you're unsure of whether you're taking too many dividends,
talk to an accountant.
Speak to Marti. Talk to your accountant and get them to do, maybe a quick analysis of what your business is doing, how it's performing, and whether you're in line with your dividend withdrawal.